What's good, people? That's the Don here with another installment of the Hustle Podcast, where we inspire and empower people to hustle. And in today's podcast, I want to talk to y'all. I know we haven't done one of these in a while. It's been a couple weeks now. I figured I'd get back to it. You know what I'm saying? And in this podcast, I want to inspire and empower y'all to understand economic cycles. And the reason I want to bring this up, especially right now, is because if you guys know, a lot of asset prices are starting to decline, especially stocks and Bitcoin. And there's a reason for those things happening. And the reasons for those things happening, I foresaw before they happened and positioned myself accordingly before they happened, because I understood how economic cycles work. Now, I'm not an expert. I'm not a genius. I mean, maybe I am a genius. I mean, I'd say I'm pretty smart. But basically what I did is read a book called Principles for Dealing with Big Debt Crisis by Ray Dalio. And beyond just reading that book, it was a very long-winded book, but it goes through multiple case studies of debt cycles, bubbles, debt cycles, debt bubbles, rising and bursting, and how countries and leaders and businesses navigated through that time. And I was listening to the audiobook version of it. My friend recommended the book to me way back during the pandemic, and he's like, read this book, you should understand how things work. And I remember listening to it, reading it, and just being like, this is really boring, I don't really understand it. Came back to it like years later, and I still don't really understand it. Like I sort of got it, but I was like, okay, like I just need a very concise way of putting this, and that's kind of what I want this to be. It's just a very concise way of putting the information that's in that book. And basically, I just went and asked ChatGPT. I was like, ChatGPT, can you give me the summary of what this book is about and what I should be looking for in terms of what the book is trying to convey? And ChatGPT, which is why AI is the future, I believe it. ChatGPT put it very succinctly, and it broke it down very simply. And this is what I kind of want to share with y'all. This is what I learned. So it talks about how debt cycles, number one is how debt cycles work. So debt cycles repeat in patterns. There's short-term cycles, which are 5 to 10 years. And then there's long-term cycles, which are 50 to 75 years. And the reason why I even want to learn this right now is because, like, if you're somebody who has money in the stock market or in crypto or in Bitcoin or even in other different types of assets that may not be doing so well right now, and you're like, what the fuck's going on? And you're like, man, why are these tariffs happening? Why is the U.S. becoming so protectionist? Why is the economy about to go into a recession? Why are people losing their jobs? If you're in the midst of all that, you're like, why is this all happening? It's kind of like, hopefully this can like shed some light as to why and how this is happening and how this is probably going to play out. You know what I'm saying? And just to give y'all context, before I even break this down to y'all, like I had a significant, I want to say like, for me, it was a decent amount of money in stocks and in Bitcoin. And I mean, I think at some point it was in the thousands. And I think I bought somewhere around 150K, 140K, 150K Canadian. And I remember reading this book and once I talked to ChatGPT, I was like, oh shit, like, I think I should probably pull out at this point, you know? Like, I only had a small loss at that point. I think it was like $50. It was like 4%, 3%, something like that. It was a small amount of money, but I sort of saw what was coming and I pulled out before things really got bad. Same with stocks. So like right now my portfolio is only down maybe like 1, 2, I would say like maybe like 3%, somewhere around there. in total in terms of my stock portfolio, my stock holdings. I don't think there's a single holding that I have is under 7%. You know what I mean? And Bitcoin, yeah, you know what I mean? Like, no real significant losses. And so, and I saw this coming, you know what I mean? I remember talking to people about it. I was like, I think asset prices are going to come down. And the reason why I understood that is because of what I'm about to share. So I was able to position my portfolio accordingly before things got bad. I'm saying, so debt cycles repeat in patterns. There's short-term cycles, 5 to 10 years, long-term cycles, 50 to 75 years. Too much debt leads to booms, followed by painful deleveraging, recessions, and depressions. Governments and central banks play a key role in managing debt cycles through monetary policy. So the key is to identify the phases of the debt crisis. So there's the early phase where debt grows faster than income, fueling economic growth. So this obviously happened back during the pandemic when governments lowered interest rates and they started printing a lot of money. They did quantitative easing, buying bonds from the banks, providing the banks with liquidity. The banks lend out the money through loans, credits, creating money in the system. And that's how you got, remember when stocks tanked during the pandemic and then they shot right back up and then they just continued to go up and then real estate went up and all that stuff. This is the early phase of that. This is when they start easing the money. The bubble phase. The bubble phase, borrowing becomes excessive, asset prices inflate and speculation increases. So this is like people day trading on stocks and using leverage on stocks, margin accounts, borrowing to buy assets, real estate bubbles. I remember so crazy. I talked to my friend about this. My friend is very sharp, Alex Joseph. He's an artist. He's on one of my songs called Dreamer. And he predicted this back in 2021. He's like, I think something's happening in real estate that the asset prices are starting to become a bubble again. He predicted that. And I was like, well, I sort of see what you're saying. That makes sense. But years later, it's starting to become true, you know? So this is when people start borrowing a bunch of money that became just easy in the economy and asset prices start going up. The top of the cycle, debt reaches unsustainable levels and central banks tighten policy. So that's kind of the point that we're at right now. Well, now we've sort of passed that. We're sort of beyond that point and we're now into the next phase. But we were just in that point where it was just like PE ratios in the stock market are at an all-time highs. Crypto is at an all-time high. Bitcoin's at an all-time high. Real estate's at an all-time high. Gold is at an all-time high. Basically, assets across the board are pretty much up. And then they start to raise interest rates to try to ease inflation because inflation gets unsustainable. And it's like, oh my God, like 8% inflation year over year. And people start complaining because everything gets too expensive and then they can't afford shit. That's what happened. We just got out of that. That was like 2022, 2023. You know what I mean? Especially in Canada and the US. And 2024, they started raising interest rates in 2023, I want to say, 2022, and kept them tight for a while. And they've just started to ease them for a little bit. They've eased them in Canada and the US because they saw what was coming. And things take a while. There's a lag. But now we're at the bursting of the bubble, which is financial crisis happens, asset prices collapse, and defaults rise. So now we're looking at the stock market is in a correction, 10% correction. Crypto is in a correction. Bitcoin's in a correction. Could be even in a bear market at this point. Real estate, I think, is still doing okay, but sales have started to slow. Gold is continuously doing really well. Asset prices across the board are kind of they're starting to decline. And that's kind of the point that we're at now. You know what I mean? And then there's the deleveraging phase, which is governments and central banks step in with stimulus, restructuring, and inflationary policies. And then the economy stabilizes and a new cycle begins. So basically, if you can read, you can kind of see how this worked out. This basically worked out to a T in the past 5-6 years. You know what I mean? And if you can see what's coming next, you can see that the central banks, if once it gets too bad, these tariffs get too bad, the economy goes into a recession, stock market tanks, crypto tanks, real estate tanks, there's blood on the street, which I think is going to come. They're going to step in with stimulus. They're going to step in with quantitative easing, and they're going to print money, and that's why I think the liberals, they might win, they might not win in Canada. I don't know. It's a good chance they might win because people really don't want to feel that pain. You know what I mean? And, now Trump seems like people are starting to hate on the Trump policies. A lot of people are still behind them, but you know what I mean? Things are starting to get expensive again. And yeah, that's kind of the point that we're at now, where we could see asset prices decline significantly, even further than here. You know what I mean? And I think they're going to step in with stimulus and continue to print money to recover the economy once it gets too bad. So that's kind of the point that we're at now. And if you can understand how that works, you can position your portfolio in the right way. Now, I understand if you're a Warren Buffett follower, you understand that you don't worry about economic cycles. You just buy consistently great quality businesses that you understand, whether it goes high or low. And if it goes lower, you buy more. If it goes high, oh well, you keep it. And that's a great philosophy, and I agree. I do follow that philosophy when it comes to my businesses to a certain degree. But at the same time, if you're somebody who wants to understand what assets to hold more of, or what assets to hold less of during a certain time, because Warren Buffett does do that as well. He understands the cycles as well. You can understand how to kind of prevent a lot of losses and maximize your gains. And so the way to do this, and this is what I kind of wanted to share, is how to position your portfolio. You know what I'm saying? So, and this is according to ChatGPT, which I think is genius. Early cycle, which is the recovery once they've already stepped in with the stimulus. Stocks, real estate, and riskier assets tend to perform well. So if you're willing to wait out this really bad phase, eventually you're going to see stocks go back up, crypto go back up, real estate, things like that are going to go back up. The mid-cycle, which is the boom, which is when we start seeing the bubble and asset prices start to increase again, leverage, debt increase. Focusing on solid companies with strong cash flow and avoiding over-leveraged businesses is what ChatGPT recommended. The late cycle, the bubble's forming. This is when you're at the top of the market and the bubble is at an all-time high. It says to shift towards defensive assets like gold, cash, and high-quality bonds. So you don't want to be in anything too risky when the bubble is at an all-time high. So for example, if you look at people that were just in the stock market and thinking, oh shit, Trump's going to pump the economy and crypto's going to the moon, stocks are going to the moon. Those are the people that really lost over the past couple weeks. You know what I mean? And you don't want to be that person. You know what I mean? Chasing hype. So at that point, once things were starting to be at an all-time high, you wanted to sort of shift your money towards cash, gold, and bonds. You want to be cash heavy. You don't want to be high in assets, especially buying at the top, unless you're someone who's just buying dollar cost averaging and you don't give a fuck. You know what I mean? And at this point, where we're kind of getting to now is the recession. And once a recession hits, if it hits, and I think it will, you look for undervalued assets, but buy when fear is high and avoid panic. So once there's blood on the street, which I think is coming, you can buy assets like stocks look kind of attractive right now. Crypto looks kind of attractive right now. It may even get more attractive. And other assets might get more attractive as well. And so I saw this coming. You know what I mean? And I shifted away from stocks and crypto and riskier assets, and I went into cash. I went into cash and I went into gold and silver. And that's kind of my portfolio. It's very heavy in cash and gold and silver right now. And I'm sort of just slowly buying crypto, slowly buying stocks. I'm not putting too much into it. And the stocks that I'm buying are in companies like these, staples, companies that I understand, like Coke, things that are going to be recession proof. And those companies have done well over the past couple months. So that's kind of how I want to share with y'all how to position your portfolio to help you hustle the markets and make sure you don't take significant losses. So that's what I wanted to share. Hopefully that helps. If it doesn't, let me know. And that's about it. Peace.